Hello, I'm Ryan Lightfoot-Brown of Fund Calibre, and today I have the pleasure of being joined by James Mahon, elite-rated manager of the Church House Tenax Absolute Return Strategies Fund. James, thank you very much for your time today.
Thank you.
And we last spoke to you around about a year ago. In your fund, you can buy a range of different asset classes. As we are at the beginning of 2021 now, what is your asset allocation like? Are you sort of optimistic or pessimistically positioned?
Well, we don't really go to extremes in this fund, but possibly a year ago we were pretty extreme in the cautious range. So a year ago we'd have had around about, I think it was up to 60% of cash and near cash assets. And I think you and I spoke around that time as to how cautious we were feeling. So the events of last year obviously gave us the opportunities. And I have to say, from the fund's point of view, it was the sort of opportunities we like. Obviously, don't like what led to it, but the fund likes that sort of volatility. So we were very active. We did increase the risk exposure a lot. So our cash and near cash element is down to around close to 30% now, so significantly lower, but still a decent block of available ammunition, if you like, for further bouts of volatility. I'm tempted to be quite optimistic. I suspect that people are underestimating this sort of bounce we could see. It's been such a miserable time, and we are fed such a miserable diet of daily woe, that I think the pent-up demand in the economy is actually huge. And I suspect that we will probably bounce more aggressively than is expected. And on that basis, I would tend to feel quite optimistic. There are going to be hiccups like the one we had last week, but as a basic principle, I feel more optimistic.
And you said that there could be some periods of more volatility coming up, which is what you're saving your cash for. What do you think could lead to those? I know, obviously, you alluded to, we saw the short squeeze last week in markets. What do you think there is coming up in the next 6 to 9 months that could cause that volatility that would be an opportunity for you?
Yes, I think half the fun of those sort of events is one doesn't actually know. That short squeeze event was interesting, but not one that people were expecting. I would just say in passing that I think hedge funds that are prepared to short that amount of a small company's stock are slightly asking for trouble, but so be it. And I suspect that particular one is probably behind us now. The obvious events come from the wretched virus and whether or not Europe is going to manage to get over its vaccine hurdle. We do need this virus. It was actually very encouraging to hear not just the AstraZeneca news, which is of course good news, but actually in the background, it was rather good to hear that the Russian vaccine appears to work very well. Because, of course, those vaccines, the Sputnik vaccines and the others, are going to be inoculating an awful lot of people. And it's very important that we get this around the world. So that's quite encouraging. But clearly the virus still has the potential to bring problems.
And the last time we spoke, you said you'd be making the most of some of the volatility in equity markets, picking up a couple of, you said, bargains, so a Heathrow bond, some Diageo bonds and equities. How did these play out in the end? Do you still own them, or have you sold them into the good performance?
Well, those ones you mentioned, the Diageo and Heathrow bonds, we still own both of those. Diageo was interesting because it was the first of the big UK corporates to tap the credit markets really before the central banks kicked in. And good for them, and it went well. And we still own that bond, which has performed tremendously well. That was a very good purchase for us. Heathrow bonds we also still own. Equities, it's much more mixed. We have actually traded out of quite a lot of the equities that we bought in those extreme times. UK market is interesting because it's quite mixed. The performance we've had, obviously, it's been depressed by comparison to other markets because of the big oils and the banks have done so badly. And I wouldn't encourage any particular return to those areas, but there are some areas that are still really quite depressed. And the mid-cap and small-cap sector must look interesting. Must look interesting to overseas buyers, I would have thought, albeit sterling is getting a bit more expensive. But a number of the big name stocks still look rather good value. So yes, happy to run with the positions we still have, though have taken quite a lot of money off the table in equities.
And one of the other things we spoke about before was some of the opportunities in the energy storage space. We're now seeing countries going through this build back better phase, meaning there's a lot of green investment going on. Do you see an increase in the opportunities coming out of this area, and what are your infrastructure holdings?
Yes, we do see opportunities in that area. To look at the specifics that you mentioned, we hold several infrastructure funds that do specifically address energy markets. So battery storage, we think, is very interesting. It's been a pleasure to see how coal-fired power has essentially disappeared, and how little some of those big gas-fired power stations are being used now because of the extent of our renewables that are coming online in the UK. And that's very good to watch. But of course, the thing about the energy from the renewable power station is it's volatile. We all know how much the wind and the sun vary. So it is very useful for the grid to have battery capacity in place to smooth it out, because just as the power coming from these renewables is variable, so is our offtake of power. You know, we all rush out at half time to go and put on the kettle, and this creates bumps in the demand for power. So decent battery storage, I think, is very interesting. So we are certainly interested in that area, and we're interested in the whole area of energy efficiency, just because a lot of those old grid systems and grid power stations are not very efficient. It's much more efficient to have localized sources of power where possible. So I do think there's interest there.
And now looking at your top 10 in the portfolio at the moment, I see there's a name that many of our viewers will know from somewhere else, and that's SONIA. Can you tell us in very simple terms what that means for investors from a finance point of view, rather than for some of the other connotations of that name?
Yes, SONIA. Yes, it's a slightly odd name, isn't it? Well, SONIA, to give it its proper title, is the Sterling Overnight Interest Average, which is a really catchy one. So SONIA, at least, is better than that. This is the Bank of England's replacement for LIBOR, which was the old interbank offered rate, London interbank offered rate, and which, of course, has had problems in the past. SONIA is an average of overnight interest rates calculated by the Bank of England. So whereas LIBOR was the banks submitting their views as to current rates, what happens with SONIA is that all the banks, the clearing banks, the commercial banks, all tell the Bank of England overnight what transactions they've actually done, and they have to be in by 7 o'clock for the early shift at the Bank of England. And they literally average them out to get this overnight interest rate. So it is more accurate, it is calculated by the Bank of England, and it provides a very useful short-term interest rate benchmark.
And so what does that mean in the context of your portfolio when we see it in your top 10?
Mainly that we do utilize floating rate notes a lot. We find them to be the most efficient and best priced from our perspective of the short-term money market instruments. Just to take a step back into the world of interest rates, we don't think that negative rates are likely in the UK, but lots of very short-term rates have gone negative. So the short-term gilt market yields are negative. Clearly, in an absolute return fund like Tenax, we do not wish to take on negative interest rates. That is quite the opposite of what the fund is trying to do. If we have a floating rate note, as we have linked to SONIA, these all pay us interest rates at a spread over SONIA. So we are maintaining a positive return on our funds from what is AAA paper. So it's an important short-term tool for us. I suppose I ought to just quickly mention, because I didn't when you were talking about things that might upset the market, I think inflation is the one that might upset the market. More than anything, it's possibly perceptions of inflation rather than actual inflation. We're going to see some pretty funny numbers coming out of the inflation figures because the comparisons to last year are going to be bumpy. So we're going to see these jumpy numbers, and that's going to make people think, oh gosh, are we getting inflation back? So inflation expectations are going to go up, even though I don't think inflation itself is going to go up. And that, sorry, it's getting a bit convoluted, but that in itself could cause a rise in short-term interest rates. I don't think they're going up far because central banks have firm control of these markets, but it could cause an upset.
Well, that's certainly something to keep an eye on for all of us. Now, as ever, James, unfortunately we've run out of time, but that's been really interesting. So thank you very much for explaining that all to us today.
Thank you.
And if you'd like to know more about the Church House Tenax Absolute Return Strategies Funds, please visit our website, fundcalibre.com. And to stay up to date with all of our videos, please don't forget to like and subscribe below.